Hi there, it is Alvin from Dr. Wealth. I just recently discovered a very superior investment portfolio and I call it the best places to work portfolio. And I backtested it over the past 10 years and it has beaten the S&P 500 returns by 2% per year. So in this video, I'm going to share with you how this portfolio is constructed and how you can build your own best places to work portfolio. So in the first place, why do I even consider this best places to work portfolio? The idea is pretty simple because we know that when employees are happy, they will deliver great work, and with great work, it drives business performances, and companies will be able to award employees with more bonuses, promotion, and everyone feels good, and stock options become more valuable as the share price go higher. So you can see that eventually also reward shareholders, and that is why we are looking at the best places to work portfolio. How it works is pretty simple, right? There are just 3 steps over here. Though the very first step is that I use the Glassdoor ranking. Glassdoor is quite a popular website for employees to give reviews of company they have worked in. And based on these ratings, they create this ranking of best places to work on an annual basis. So that is what I use to populate the holdings for the best places to work portfolio. So I'll select the top 20 companies from the list, and they must be publicly listed, right? Because they are private companies, but investors aren't able to invest them conveniently. So we only look at the top 20 publicly listed companies. And I'll allocate equal capital to each stock. So 20 stocks means that it's about 5% each. There will be no special weighting whether their rankings is higher or whether their market cap is bigger. So it's all equal weighting for every stock. And lastly, every year in January, Glassdoor will release the new ranking, and there will be changes to the list of companies, and that's where we need to sell if the stocks are outside of the top 20, and we need to add in the new one in the top 20, and that's what we call rebalancing of the portfolio. So there's only once a year you need to do this. But before I show you the year-by-year results and the holdings, I just want to let you know that this portfolio was actually first released in FinBite Insights, and have a look what FinBite Insights is all about. Today's episode is brought to you by FinBite Insights. So this FinBite Insight is started by Alvin, and that's me. And each day I will articulate my thoughts about the financial markets. Just by reading in less than 3 minutes, you will be able to get a very good understanding about what's going on, what's the most important thing that you need to know about the financial markets for that day, and how do you interpret it so that you can make better investment decision out of it. So do remember to go to finbiteinsights.substack.com, and you can subscribe it for free and start enjoying the daily insights that I'll deliver it to your inbox. So I'll start off with the very first year that I formed that portfolio, which is in 2013, and these are the top 20 stocks then. Okay, include some of the famous names like Meta Platforms, Alphabet, and some of the less well-known like National Instruments, Southwest Airlines. So it's a good mix of companies and different industry. There's even oil and gas like Chevron that's inside. So I'll say that it's pretty diversified in terms of sectors. And in 2013, the first year, it performed quite well. The BPTW, or the Best Places to Work portfolio, was up 39%, while S&P 500 ETF was also up 32%. There was a 7% outperformance in the very first year, so it was a rather good start. And then come next is 2016, which I want to highlight. So in 2014 and 2015, the portfolio did outperform the S&P 500, but there's nothing much to highlight, right? So I'll only focus on certain key years where there is a performance highlight to talk about. So in 2016 happened to be that year. You can see that the holdings are very different from 2013. There are some similar companies that still exist like Meta Platforms, Alphabet, but we saw Chevron and Southwest Airlines get lower down in the list, and there are some new ones like Guidewire, HubSpot. Okay, so there is this refreshing of the holdings on a yearly basis. And why is 2016 special is because it is the very first year after 3 years of outperformance. It is the very first year in 2016 that the Best Places to Work portfolio was underperforming the S&P 500. In this case by 3%, right? S&P 500 was up 12%, and the Best Places to Work portfolio was only up 9%. And in 2018, 2 years later, is also a year to highlight. And these are the holdings. We still see Meta, Alphabet, and these two companies has been in the ranking for every year in the past 10 years. And I guess it's not surprising because you do hear a lot of benefits and perks in these two big tech companies. And we see a new company called Lululemon, right, which is selling very expensive, yoga wear, especially targeting the ladies. And we don't see Chevron anymore, right? The oil and gas company is out of the picture in 21.8. And this is the performance in 21.8. Why is it special to talk about? Is because S&P 500 actually generated a negative return on that year, but somehow the best places to work portfolio managed to still edge out a 10% gain, while S&P 500 was down 5%. There was about a 15% outperformance in that year. So that shows you that even in a down year, a general market down year, the portfolio is still holding up pretty well. So far we can see that the performance of this portfolio is rather fantastic. And come 2020 is even better. That is the COVID year, and this was the holding. You can start to see that the portfolio begin to have more tech holdings, right? More weighted to the tech side, more software related. But of course, we also see some non-tech companies like number 10 Camden Property Trust, 14 Bristol Myers Squibb, 16 Taylor Morrison Home, 17 Manpower Group, 19 Cummins. So probably about 25% is non-tech, but 75% is quite skewed towards tech side. And we know that in 2020 the tech stocks did very well in hindsight, but the best places to work portfolio we have taken care of that. And the outperformance was the largest in the past 10 years, right? The best places to work portfolio was up 39%, while S&P 500 was up 18%. So there was an outperformance by 21%. So that was a pretty crazy year to talk about. And in 2022 is also in a highlight year, okay, that I really must emphasize, okay. So you can see the holdings is again pretty tech-centric, okay, except some of the non-tech will be like Royal Caribbean Cruises, Delta Airlines, Southwest Airlines, okay. Other than that, you can see pretty much is quite tech focused. And we all know that 2020, again in hindsight, is a very bad year, especially for tech. There was a very heavy drawdown. Best places to work portfolio was down the worst by 40%. Very huge drawdown during the market crash in 2022. As compared to S&P 500, it was only down 23%. And it was largely helped by the oil and gas companies in 2022 because oil prices was skyrocketing due to the inflationary pressure, right? So that helps to that's helped to cushion the S&P 500 drop. But we can see that the best places to work is very tech heavy, and there isn't any oil and gas company that's within it, and that's why it didn't have that cushioning effect for its portfolio returns. And I deliberately wanted to also show you a very big drawdown year, a crash, right, to test the resilience and robustness of the portfolio. Okay, so it does have a heavy drawdown, right, in this case, but we want to see overall what's the performance like in the past 10 years. And this is the table, and let me blow it up for you. On the most right hand column, you can that's the outperformance and underperformance by the best places to work portfolio. Out of the past 10 years, 7 years, you can see the best places to work portfolio have outperformed S&P 500, and in a few occasions it is a double-digit percentage of performance. Is really very fantastic. And out of the 10 years, only 3 years it underperformed, right? So it's still quite a stellar performance if you ask me. And overall, on an annual compounding return basis, the best places to work portfolio was about 14% per year in the past 10 years, while S&P 500 is about 12%. So there's a 2% outperformance on the yearly basis. So despite the 40% drop in 2022, the yearly returns is still very fantastic. And I deliberately end off that year with a very bad return, right, to show you that the portfolio is still quite an impressive one. How about 2023? This is the list of best places to work portfolio. Again, it's still rather tech-centric, but we can see there's a superstar performance, and there's NVIDIA, right? Because this is an AI year so far, and NVIDIA is one of the best performing stock. And we can also see that it's included in the best places to work. And likewise for other Magnificent 7 companies, right? Alphabet, Microsoft. Oh, and for the first time I see that Meta is not in this list, okay? Otherwise, Meta would have done very well as well. So this portfolio this year has been doing well, and this is the results, okay? As of the first half of this year, the best places to work portfolio has gone up 40% and S&P 500 has only gone up 10%. So that is a 30% outperformance. That makes it actually the best year so far in the past 11 years of comparison with S&P 500. So all in all, these best places to work portfolio has three benefits, right? The first is that it's a sound strategy. Why? Because if you understand that employees are very important to drive business performance and in turn reward shareholders with higher share prices, that logic chain is there. And the second is it's pretty simple because the Glassdoor ranking is public, and every year on January it will release the ranking, and that's where you can get that data, right? You don't even need any special tools or special access to it, and you just need to do it once a year. It's not like you need to trade on a daily basis or a weekly basis. You just need to do it once a year. You just follow that top 20, you just blindly follow the rule, and the results have shown that they are pretty fantastic, right? So, and lastly, it's effective because the outperformance is there, and it's amazing because it's not a difficult strategy, and yet you can beat the S&P 500 by 2% per year. So hopefully you find inspiration in this strategy. You can feel free to explore it and test it for yourself. And I hope you like this video. Give me a thumbs up if you want more videos like this, and subscribe to the channel so that you'll not miss the next update. Thank you for watching, and I'll see you in the next video.